Hello, everybody. Welcome to Monday. The S&P 500 was down about 0.2% today. Kind of a wild ride and a really wild weekend. Of course, on Friday, Silicon Valley Bank went under. On Sunday, Signature Bank in New York went under. And of course, there's a lot of big depositors, big companies with huge amounts of money, much more than the $250,000 that was covered. Lots of consternation about that over the weekend. And then the Federal Reserve, the Treasury, and the FDIC got together in a joint statement saying that they were going to cover all the deposits for both of those banks and set up another pool of money that would backstop other banks that might be having problems. They said it's not a bailout because they let the shareholders of those banks and the bondholders in the bonds of those banks basically go out of business for all intents and purposes. So very interesting how this is playing out. Market stabilized on that news, and it is good news as far as that goes. We've basically become a bailout nation, and this is sort of an important point to consider here. Although we can have these big, really crazy events that happen, we have a situation where the government can continue to walk in and change things, especially as far as the stock market goes. If we look at what happened in the pandemic, it dropped 35%, and then the government comes in and puts out stimulus money and all these different measures to try to stimulate things, and we end up with a monstrous rally in the stock market. Really went too far to a large degree that we're kind of unwinding somewhat now. But in 2008, when Lehman Brothers was not bailed out, it ended up being a house of cards and a big fall, 30% drop, give or take, from that point forward in the stock market. And the government ended up having to put out a lot more money in bailouts. So that's one lesson learned. I think they're figuring out that if they do these bailouts, it might save other money in the future. And also politically, if you recall, we kind of had a Republican-controlled White House, for example, that was flipped over to Democrat because the economy was falling apart during the election. I don't think any White House wants that on their, on their radar as they head into a presidential election year. So I think we'll continue to do these bailouts. There is some end game to this, in my opinion, where we won't be able to do these for some reason. So that'll be kind of interesting to see how this plays out. But this isn't it at this point in time. We're now looking at, the CPI number coming out tomorrow. Is it better or worse than expected? See how the market reacts to that. But more importantly, what the Federal Reserve does next week was expected that they were going to do a quarter point, and then that moved up to a half a point. And even just last week, we had testimony from Chairman Powell saying, leaving the door open for a half a point. And now we got people saying a quarter point seems like the maximum. Some people are saying maybe even zero. And a few notable people are even saying they might do a rate cut. So this is what we talk about when we say, things can break. So when you put an economy, or a world economy in this case, under pressure by raising rates as fast as they have here, something can break. And that's exactly what happened this weekend. Now, we got signals on Wednesday of last week to remove our positions. We usually wait a day to see if it's still going to happen. And then on Friday morning, before the Silicon Valley Bank piece, we moved all of our stock positions into T-bills on our IRA type of accounts. We use a different, slower trigger for our taxable accounts because we don't want to generate as many transactions. And that triggered today. So we'll be making those changes tomorrow. Unless the market really goes up, we'll wait until there's some weakness in the market, but we'll be moving those stock portions that have either small gains or no gains into the T-bill portion. We've already moved the bond portion into some really good positions of kind of that intermediate term bond and longer term bond. That's paid off quite well. We were short the bonds, and that worked out pretty well too. So that's been really good. What I've been saying all along is you watch the price for what's happening. We tend to look at, VTI, the Vanguard Total Stock Market Index, and BNT, the Vanguard Total Bond Market Index, as our main barometers for what we're looking at. And, there's a saying that it's in the price. So, the market was already starting to erode. And a lot of times there's things that we don't know about that are happening behind the scenes, like the Silicon Valley Bank, but other people know about it. And so you just watch what's happening to this price and you react to that price. And, that's what we do. And now we have a whole bunch of, I think, fairly sophisticated triggers that we've developed over the years to try to give us these signals. But that's what's happening right now. Again, if you have an IRA account with us, you are not involved in these downturns that have been happening, with the Silicon Valley Bank situation. Again, that could be the wrong things to do because we get enough stimulus money coming out here for some reason, or if they actually cut rates, the market's probably going to go up and we'll have to reverse these. But in the interim, we're reacting to this price. The price is still going down. It's been 5 days in a row that the S&P is down. So I think it's prudent to be cautious here. And then we're going to do the same thing with the taxable accounts tomorrow. So anyway, that's what's happening right now. Look forward to being able to talk to you again tomorrow after we get the CPI report. I think we'll have some really interesting things to talk about then. So look forward to talking to you then. Thank you.